While we're waiting, so what are some of the, I guess some of the biggest questions that you guys have when it comes to utilizing these cash value life insurance policies while we're waiting? Did you guys hear me?
I can hear you. Just trying to think of a real tough question for you.
Okay, so one of the first questions is the interest rate better than the bank if I borrow? Okay. Um, so now that's going to be dependent upon the type of policy that you use. So, and it depends on the carrier, really. So that's going to be the main thing. I think the interest rates fluctuate I see from what I've seen as 4.85 all the way down to all the way up to 7%. The highest right now that I've seen currently is 6.75. So banks usually offer, I mean, prime usually 6 to 7. I mean, if you have a really, really good credit score, um, maybe 8. Um, it depends. And then like even if you do go through a HELOC, that's going to be a little bit higher interest rate as well too, as far as interest only payments. So is the interest rate better than the bank if I borrow? Technically, yes. And then not only that, it's on a growing asset as well. And then Michael says, when taking out a loan, how soon do I have to start making payments back? So this is not reported to credit bureaus. You're not on the hook to repay this. There is flexible repayment schedules. You don't have to pay it back, but if you don't pay it back, it's going to be pulled from your death benefit at passing. So meaning that, let's say, for example, you had 100,000 in cash value, but your death benefit is 200,000. Let's say if we took a loan of 50, then and we never paid that back, that 50 is going to be pulled from the death benefit plus interest if you don't ever pay it back. So your death benefit is looking at anywhere between 150 to 140. So it's just going to be pulled from your death benefit. But if you want to be an honest banker, you would want, if you pay back the bank, you want to make sure you pay back yourself. So just because that flexibility is there does not mean you become undisciplined. So that's the main thing. But my policy won't default if I don't pay that loan. No, it will not. There's no default as long as you continue to fund it, as long as you continue to be responsible with your money. This right here, the main thing is all about responsibility. It's not, there's no default, there's no credit check, there's no I guess you can say that there's no restraints on it, but you want to be able to be responsible with it. Like just treat it as if it's your own bank, right? So, and the thing is, it's a growing asset. Even when you borrow against it, you're still going to continue to compound and grow. And you're going to see that today with the actual results that we have from policies. So, how soon could you pull out a loan after I start a policy? Honestly, within the first 30 days. So these are great questions, guys. I mean, a lot of these questions will be answered. Uh, but yeah, within the first 30 days, as long as it's funded, as soon as you fund it, you should be able to access that money right away. So let me see here. We have someone else in the waiting room. All right. Okay, next question. Are the loans automatically approved or does it go through an approval process? So, like I said, this is going to be your capital, your money. So there's not any approval process. Literally, there is a process where you go on your online portal and request it, but there's no approval on what you can take out, right? So there's not like an underwriting process for you to get this loan. So it's your money. You take the loan out. You say, hey, a policy loan request, click the button. Just recently, we were able to, honestly, yeah. So there's a policy that we funded, I would say, right at the end of December. And we just requested the loan. Actually, the loan was deposited like last week. So it's actually could be within 30 days and with all things being smooth. So that loan was already taken out. It is being used for consolidation of debts, and now they're repaying themselves as they go. So how soon can I start policy? I mean, as soon as possible. Uh, the main thing is the application process. So you do submit an application, you go through underwriting. It's going to be based off of health, and then based off what you want to fund. And you want to minimize the death benefit as much as possible. So you know what? Why don't we just get started? I think yeah, I think we'll go ahead and get started. Well, by the way, my name is Justin Corpus. I am CEO and founder of Trevere Financial. So we have been getting into a lot of implementation of these different strategies with private lending, peer-to-peer lending strategies, private real estate deals, funding businesses as well, leveraging these policies. So really without having to use the bank essentially, and really also to add value to our current client list to generate cash flow. So we're going to go through actual case studies. These are actual numbers. These are actual clients. Obviously, I blocked out names for privacy purposes, but I'm really excited for you guys to see the implementation for this. All right, so first and foremost, let's preface it. So there's two types of permanent life policies. One's going to be the IUL, the Index Universal Life, and one's going to be whole life. What is the biggest difference between the two? One's tied to a stock market index, not invested in the stock market index, but tied to a market index. You have a floor and you also have upside as well. Upside potential, downside protection. And it does have flexibility. There's a very low minimums and very high maximums, so a lot of flexibility on what you can deposit into an IUL. And there's different loan provisions. So loan provisions meaning that, let's say, for example, if you wanted a no-cost loan, you would do what's called a fixed loan, which is they charge you 2% and credit you 2%. The downside to that is that it does dip into your principal. So it defeats the purpose of having your dollar do multiple jobs. So now the other type of loan is going to be a participating loan or an index loan, where the max interest rate they will charge you is going to be 5%. But let's say the stock market index does 10%, you make that positive arbitrage on top of the activity you do with that loan. So it's still going to earn interest as if you never touched it. And so now let's go to whole life, right? So it's not going to be as fancy. There are stronger guarantees within whole life. It's not as flexible as IUL. I will say that there's smaller corridors on a whole life policy. It is predictable and steady, so I would say this is comparatively to a high yield savings account, right? You're going to look at an internal rate of return anywhere between 4 to 6%. Though we've seen some cash on cash growth pretty high. So again, both policies build cash value that can be accessed through loans or withdrawals, creating a personal banking system. The key difference lies in the mechanics. IUL offers market link potential, while whole life provides the guaranteed certainty. So that's the main thing, biggest difference between the two. And it's going to be all about preference. So if you want a little bit more upside, we do have clients earning 15, 16% in the index. But we also have whole life where it's stable. And you actually look at, you'll see here that some people earned 8.8% inside of their whole life policy. So Let's go ahead and take a look. The first strategy that we can do, and this is an actual client that we're implementing as of now. We already paid 2 quarters of their schooling. So it's self-financing for a child's education. So this child is going through nursing, right? So you can borrow against it. You don't necessarily have to dip into or I would say you won't necessarily have to take a student loan or rely on financial aid, right? So both of those obviously kind of put a burden on you. So there's, like you see here, borrow tax free, flexible repayment, continued growth. So it grows as if you never touched it. So it's an asset that continues to grow while you're using those funds. So this is the case study here. Let me move this Zoom thing out the way. So case study. So it's for nursing school. I'll say the school, it's just PUC. They needed funding for the school. Like I said, they want to minimize using banks or school loans and have more control over the capital. So each quarter was roughly about this much. Now, was that amount needed for the quarter? Not necessarily. So you're going to see here. All right, let me move this Zoom thing. Okay, so these are actual transactions through someone's whole life policy. So the first one you see here, the net loan. Here, I'm going to annotate here. So you see the net loan right over here. Sorry about that, net loan. So it was about 7,500 that they needed. And then as you can see, this person is an excellent banker. This is a prime example of someone taking a loan and also making their loan payments, but also depositing more into their account over time. So you can see all through here, all the payment activity. So loan payment, regular payment, additional premium payments. So this continues to build that cash value. Even when they borrow the money, it's still going to earn as if it's never been touched. So that was the first one. And then the next thing, let me erase this real quick. Now over here, the next loan was 1231. So this is very recent, as you can tell. So 7,500, that's all that they needed for the funding. They got the loan. And then from there, you're able to fund the school and make the payments. So as you can see, they're a very responsible banker here. So we have another person in the waiting room. See, so those are actual implementation. So they paid for the first 2 quarters of the schooling. And so now let's take a look at the next one. So client was able to finance her children's school. Cash value still grows. So even you see here, the cash value growth year over year, even though you see the loan information here, it's still going to grow as if you never touched it. So the net growth was 3.039. So it still grew by 8.8%. So she's self-financing it. And it's really an investment because I think the main thing with the child, like they're going to be set. Their school is taken care of. They're going to have a great career, a very solid career in nursing, as you guys can tell. But not only that, they also have an asset that's going to continue to grow and compound again, as if they never touched it. So this is just one case study here. And so now this is something as well. So we have peer-to-peer lending with promissory notes. So if you guys don't know what promissory notes, essentially it's a contract, right? So it's written document, basically lending to, you see, hold on, we got something. Okay, yeah, no worries. We went ahead and got started. So the main thing with a promissory note, it's basically just like how it sounds. It's a promise to pay. So it's written document and it's looked over, obviously, by tax professionals as well. But really what it is to either lend to a business, lend to an individual for debt consolidation, but we always make sure that there's a level of collateral. So that way we protect the client. So what the client does with the policy, they borrow against it, and then they put it into a promissory note or lend it with someone, and now they're generating cash flow with it. So this is an example promissory note. So I blocked out the names. And this is going to be a 5-year note, $33,000 loan, and it's 11% interest rate. So as you can see, they borrow 33,000, they lend it to that individual. The individual that put their or used collateral was going to be their 401k, right? The equity in their 401k. So we always want to make sure our client is protected on both ends. And then the monthly payment or monthly cash flow this individual is earning is going to be 1750 per month. And so over here, if you can see the total interest over the 60 monthly payments, $10,000 in interest here. So now over here, this is going to be their cash surrender value, so they can borrow 33. They're still going to earn as if they never touched it. So remember that these two are different buckets. Accumulation value is going to be where you get credited the interest amount. The cash surrender value is going to be the borrowing power that you have. So that's going to be the main thing between the two. And so since they're taking that 33,000, it's still going to earn off that 41,200, or as you can see here, 41,997. So they're earning cash flow now, and they're still earning interest on their policy as if they never touched it. So let's look at this breakdown here. Okay, so this is their recent statement as well. So they just got their statement. Look at the interest rates. Some at 5.53, 9.53, 11.43. So double-digit returns that you can earn inside of it. So let's break this down very clearly. One way in the policy, the next way is earning cash flow from the promissory note. And then that collected cash flow that they're getting from that promissory note is putting into a high yield savings account. So they're earning dollars 3 different ways. Okay, so let me repeat that one more time. They're earning money inside the policy. So as you can see here, right? And then now they borrowed against it, still earning off the original principal. Now they're lending it, earning cash flow 1750 per month with 10,000 total in interest paid. And then on top of that, they put that collected capital, that 1750 per month, into a high yield savings account. And so then that's the third way. So you have $1 working in 3 different areas. So that's really how you can maximize the earning potential. Again, it's all stewarding that cash, right? So this is actual implementation here. So now this is not as fancy, and this is just really going to take a lot of discipline. It's going to be the debt consolidation using the policy. So we typically see credit cards at 18%, 24% APR, even personal loans 10 to 15%. With these types of policies, I mean, like I said, on the low end, 4.85 to the high end up to 7% that I've seen. Um, excuse me, it says 5 to 8 here, but I have seen a cap of about 7%. So that's the main thing. This is going to be, again, really meticulous and really disciplined in your approach when using the policy. So this client consolidated $46,000 of debt through the policy. This is the tool that is used. It's going to be a whole life policy. Okay. So as you can see here, let's break this down again one more time. They make their premium payments, right? As you can see here. And then what do? They take a maximum loan request right over here, 28,000. Boom. But guess what? They're going to be an honest banker and they're going to pay themselves back. And so you see here, premium payment, paid up additions rider, loan payment. See how they're chunking it out. So that's already 28,000 in debt already consolidated. So let's look at the next one. So now again, another loan payment here. See, he's paying himself back. But look, another loan initiation, another 11,000. So now that's $39,000 in debt already that they consolidated between the two loans. But you see how he's continuing to make his payments. This is not us being irresponsible with the money. It's just being a good steward with the money, right? And he's all keeping it within his ecosystem. So this is how you can just use the policy itself to consolidate debt. And now let's look at the next page. Okay, so now this is the last one. As you can see, the dates continue to get closer to today's date. Obviously, 4/7/25, 6/25, 8/25, right? So over here, you see the next loan initiation, another 6,700. So you saw the first loan, 28,000. Second loan, 11,000. This is the third one, 6,700. So that's $46,000 in debt that he consolidated. But again, he continued to deposit money. He continued to pay back his loan so he can redeploy the capital. That's again creating this banking system while still earning interest off the original principal. Again, being very responsible with the money. And now this is going to be some of the fancy stuff. We have a partner company that does fix and flips. I'm actually meeting with the individual tomorrow as well. We have um, a client that leveraged their policy at about 50K, went into the investment and is going to be making 18%. So you see here, real estate generates 12 to 18%, but you're going to see in this next slide the promissory note there. So again, this client wanted to vet the process. Obviously, she did her due diligence. And then now you'll see in this next slide the actual promissory note that they're implementing. So you see here, principal amount 50,000, interest rate 18% compounded per annum. What does that mean? Annual basis. So now this is not a cash flow play because look at the payment process. Balloon payment. So it's going to be a balloon payment. So as you can see, this is what it's used for. Borrowed money will be allocated and used for one or more properties in construction and or down payments. So 50,000, getting an 18% rate of return and still earning off the original principal in her policy. So just for proof, this is what she did. So you can see the loan, but you also can see the payments that she has made as well. So after taking the policy loan, she's earning 18%. So 18% of 50K is 9,000, right? So 9,000, and then she also earns a dividend. So last year she got a dividend roughly around 6,800 around there. So what we're projecting for the dividend this year is between 6 to 8K. Obviously, that's being conservative. So if you look at the total net return, 9K plus 7K is 16K. So that's a 32% cash on cash return just by adding that one additional step and parking it inside of the policy. So instead of just getting the regular 18, she got 32. Right? That's how she's maximizing her dollars. So again, that's another way to use the policy in these private real estate deals. So again, they're out here in the Bay Area, Berkeley area, San Ramon area. I mean, they're a great individual. So anyways, this is just another case study that we implemented as well. All right, now this one is going to be another one. So we have a local business out here in Vacaville that we leveraged a policy loan for and deployed it and lent it to them. So now sometimes it may depend as far as collateral when you're lending to this business. We want to make sure that either the monthly revenue is great or they have some level of collateral to back it up. So the monthly revenue for this business was roughly about 700 to about 1.1 per month. So it was a $45,000 loan you'll see here. Obviously, it's not significant to what their cash flow is. So 3%, or excuse me, 3 years, 7%. And that individual that lent it is going to be collecting 1393.57 per month. So again, very similar to the other promissory note for debt consolidation. They can put that either into a high yield savings account, put it back into their policy, however they want to deploy that capital. But they're earning cash flow on this. So if you look at this, oh, we missed a slide here. Anyways, the capital that we're using for this is from the, let me go ahead and give me 1 second, guys. We're actually missing. Oh, here we go. Sorry about that. Okay, so this is the payments. So she lent it out at 45,132.90. 3-year note, 7% interest rate. This is an amortization calculator. She's collecting 1393.57 per month. And then now you can see the business is actually giving her much more than that. 2,500, 1,500, 1,500. And then what she's doing is taking some of the excess capital and putting it into what's called a premium deposit fund, which is yielding her another 5%. So again, she has the cash flow coming in, the 1,400, and then she's either doing one of two things, repaying her policy loan or putting it inside of a premium deposit fund. So again, this is another way to lend to businesses. Obviously, that's my own vetting process in providing these opportunities and these deals. So it's not just the policy itself, it's the policy and the other strategy you want to implement, whether if it's private real estate, whether if it's debt consolidation, whether if it's private lending to someone who needs debt consolidation, right? Whatever it may be, it comes down to the individual, what their risk tolerance is, making sure there's collateral set aside, and that you're covering on all bases. So we want to protect the client as much as possible. So it's a win-win. The business gets the funding, the real estate deal gets the funding for the private real estate deal. The individual who needs debt consolidation, who can't get approved for any other loan, gets the debt consolidation, but has the collateral set aside in the event there is a default, right? So again, making sure we're covering on all bases. And like I said, the policy itself is not going to be, and I have to reiterate this, the policy itself is not going to be the end all be all. What you do with the policy, obviously that's going to grow. I'm going to project it at 6%, but we've seen 15, 16, 17%. I'm going to project at 6% very conservatively. That's going to be a great asset in your tool belt, but using this with other strategies and having the implementation and then also making sure that you're protected on all bases. This is another way to invest alternatively. And then this is really just the process. The infinite banking concept is to build the cash value, borrow for opportunities, education, you see here, business, real estate, debt payoff, capture the returns, and then really just controlling your own capital here. That's really what I wanted to provide, is that these are actual clients implementing some pretty, complex in-depth strategies. But again, I do all of the due diligence and also want to make sure that the clients are protected on all bases. And also the client has to do the due diligence as well and stick with the plan. So that's the discipline aspect to it. So again, this is just reiterating my point, which is the power of uninterrupted growth. So let's say from a bank, right? You have $50,000 in the bank and you want to go into a real estate opportunity. You go from the bank to that opportunity. Now you have $0 there. Versus if you have 50K in the policy, you borrow 50K, it's still going to earn as if you never touched it. Right? So you're earning dollars here while earning interest over here with the other opportunity that you have. So as you can see, the traditional withdrawal, if you remove 50K from investments, that money stops growing entirely and may trigger taxes. Policy loan, your full 200K keeps earning while you borrow 50K against it with uninterrupted growth. So that's the main thing. Whether if it's IUL, whether if it's whole life, it's going to come down to the client. Going to come down to what your situation is and what you prefer. All right, yeah. So these are just some critical consideration and best practices. So understand the policy loan mechanics. There's different types. There's going to be, let's say, fixed loan, participating loans, right? And then monitoring that as well. So if you would pay the bank all this interest, you want to make sure you pay yourself. Consult with a professional. We have plenty of the team members here. So we have another question. We'll get to that right after. So we have plenty of the team members here. So it's making sure that you assess the situation and completing due diligence. Tax implications matter. So policy loans generally tax-free, but policy surrender with loans creates taxable events. So if you have a loan outstanding and your policy is at a gain, that's where it can be a taxable event. Again, that's going to be someone you need to talk to. The tax professional on here is going to be Jerry Strong. That's one of our tax professionals on our team. So I suggest you getting in contact with her, direct message her on any of that. And then I believe that's the last thing. So I'll go ahead and go right into that last question. Are the cash value from monthly contributions compounded daily, monthly, or annually, and at what rate? Okay, so that's if you're contributing monthly, they're going to credit you on an annual basis. I mean, that's going to be, I have to say that's going to be, it depends type of thing because there is some options with like different carriers that you can actually lock in the interest rate for the year. So let's say you're up 15%, you decide to lock that in. That's your interest rate for the year, no matter what other dollars that you put in. So are the cash value from monthly contributions compounded daily or annually, and at what rate? And okay, so the rate, if you're going whole life, conservatively, I would say 4%. You're looking at 4 to 6% internal rate of return. If you're looking at IUL, just a couple of basis points above that, which is going to be 6 to 8%. That's what I would estimate on that side of things. But again, like you will have those years where it's 15, 16, 17%. Even you saw that last rate of return, it's at 11.54, right? So that was the main thing. I can't say that there's a fixed interest rate, even though there is with an IUL, but you're also limiting your upside there. So you can have a fixed allocation at 5.5%, but again, it comes down to the individual on how you want to allocate it and what your risk tolerance is. Obviously, there's downside protection. There's no downside, but they do have a 1% floor instead of a 0% floor. All right, over here. And then let me go back. So just so you can guys see the returns. So these are some of the returns here, right? So again, like I said, it depends, but you know what I'm going to do is actually bring it up live. So if you guys can ask any other questions, any other details that you guys have while I bring that up, I'll be happy to answer. I'll show you guys some actual rate of returns as we go live. No other questions, guys?
Yeah, just shout them out at this point here. Might take too long to type them. Well, okay, how about I'll ask you a question, Justin.
Yeah, absolutely.
So when you take out a loan from your policy, say your whole life policy, you have that interest rate that comes with it. Does that get added onto the cost of the policy, or is that kind of floating somewhere else? Do you have to pay that every year, or can you skip paying it?
Okay, so okay, say that question again one more time.
Yeah, so if I take a 50K loan out and it's 5% interest rate that they're going to charge me, does that 5% charge get added onto the cost of the year of the policy for the year, or is that a separate cost that you can kind of pay off?
Yeah, so there's going to be two different buckets, right? So there's going to be your cash value bucket, and then there's going to be your loan balance bucket. So that interest rate that you said at 5%, that's going to be added to that loan balance. So let's say it's 50K, you took a loan of 50K, then it's 5%. So 10% of it's 5K. So it would be 2,500 for the year, right? So that's the total amount to pay off is going to be 52,500. So it's just added, it's not added to an additional cost with the policy, but it's
Mm-hmm.
added just to the loan balance. So think of the two buckets. So cash value is going to be your equity that you built up, right? And then the the loan balance is going to be that's going to be just a separate loan balance, right? That's what gives you the liquidity
Right.
essentially. So it's going to be added to that balance there. So yeah,
Gotcha.
that's yeah. And then now let me show you guys some actual rate of returns. This is live. So I went onto one of my portals with one of our carriers that we work with, which is Allianz. So this is some index rate of returns, 11.92, 9.6, 10%. You can see the index allocation here. Okay, we got another one. Okay. Yeah, so when you the question is so when you or when you are paying back, does the interest to back to I'm sorry,
Does it go
uh
back to the cash value?
yeah. So does it go back to the cash value? So yes. Uh okay, this is one thing too. When you it's based off of simple interest. It's not amortized interest. So let's say, for example, you took that loan, and let's say annually it's 5%. So let's take that 50K example, for that example. So it's 2,500 at 5%. Okay. And since it's
Mm-hmm.
simple interest, and let's say you pay it back in 6 months. So the total interest that you would pay is 1250. So that's going to be 1250. So it's going to be 2.5% interest. So technically the interest is given back to the insurance company, but if you pay it off sooner, there's going to be less interest. So it's almost like non-existent depending on how fast you pay it back. So it's on a simple interest schedule. And then not only that, you can also, this is something too, you can make positive arbitrage in your policy, meaning that even if you borrow at 5, let's say you gained at 10, then you wouldn't have to worry about the interest because you're earning a positive arbitrage there.
You're outpacing it, basically.
Yes. Yeah. So what is the average? What is the average time frame when a loan can be implemented after a UI or IUL policy open? The average time frame when a loan can be implemented. So as soon as it goes into issue and it's paid and you funded it, like I said, within 30 days. So I had an individual fund a policy, I mean, close to around 40, 50K, and they immediately took a loan. So it was like funded around right at the end of December, and they just got deposited that money just a few days ago. So within that 30-day time frame. And then
Yeah.
now over
Can
here.
I add something to that?
Yeah, of course.
Yeah. And so basically, as long as you have cash value that first year, you can take a loan out, like Justin said, within those 30 days. So it's pretty quick. And like depending on what the vehicle is, IULs can take a slightly longer to get you your money, but then Whole life could be a little bit quicker. Just depends on the carrier.
Yeah. So over here, you can see these are just the actual returns, policy numbers. This is the interest rates that they're earning. Obviously, I blocked out the names. I zoomed in and blocked out the names. You can see some pretty solid returns here. It's because of the way we allocate them and also the index that they're involved in. So I want to show this one as well. 14.56. There's one over here, 16.39.
16. Nice.
Yeah, 15.29, 16.39. So again, I like to project at 6%, but look at the interest rate here, right? So sometimes you will outpace that heavily. Let's go ahead and see this. Okay, so two questions. Using the same dollar and earning three different ways, what's my tax implications? So the tax implications are going to be what you earn inside of the high yield savings account. And then on that amortized note, right? So obviously there's a schedule on there, right? So going back to it, there's a schedule. So if we look at the schedule, there's going to be interest and principal. So obviously you're getting your principal back, so that's going to be just money paid back to you, and then you're going to be taxed on the interest earned based off this schedule. So that's the thing. Again, like I said, I would consult with Jerry here on this call. She's our tax professional. And then let's go. We got some more questions here.
Yeah. So next question says, does it depend? iPhone 3, we meet again. So glad you're on here. He said, or she said, does it depend if you start the policy with a large lump sum versus the monthly payment policy?
Yeah, so my contribution to that, and then so you can add to that if you want to. So does it depend if you start a policy with a large sum? So you will have a lot more liquidity with a large sum upfront deposited into it. Versus if you do pay monthly, I mean, like I'll be honest. I'm just going to be very truthful with you guys, or if it's going to be $100, $150, and you want to borrow from it, that's not going to be feasible. I wouldn't even. I think at that point it would probably be better for you to start saving up and start reallocating your money, start budgeting a little bit better, um, as far as a monthly side. But after that first year, let's say if you're contributing a very high amount monthly, after that first year, you will have a lot of liquidity. So the lump sum does help. It does kind of like inject that cash value. So yeah, and you can see, like I said, 16% interest rate over here. So let me see here. There's something blocking the way. Oh, it went away there.
Yeah.
Oh, okay.
I guess what I'll add to that is, just kind of echoing what Justin said. It just depends. But yeah, basically, if you lump sum in the beginning, it can eat basically the cost of insurance that first year completely, depending on the size and how it's built. And then that way, boom, you immediately have cash value and you can go right ahead and you just kind of give it a little head start, as opposed to if you start with, $100, $200, it's going to take a little longer because that, there's still a cost of insurance that you have to pay for. So while we can try to minimize that, it's still there. So less goes to cash accumulation, the lower the amount is. I hope that makes sense. And then Maria asked, so far as the loan, we can borrow up to 80 to 90% from the cash value ? And so, yes, we can, but it doesn't always mean we should. That's kind of like, we probably don't want to take out more than 80% because unless you have a clear plan in place to pay it back, the cost of the policy plus um, any kind of interest that you have to pay on that loan, the amounts get bigger the more money you take out. And so you don't want to accidentally cause the policy to lapse if you are not making payments back into that to basically reset your cash value.
Yeah, this is what I would say. If that's the case, right? Yeah, like just kind of just reiterating your point, so is 80 to 90%. Yes, you have 80 to 90% loan to value, right? But that comes with a level of responsibility. So what is the activity that you're doing with that loan? Is that going to net you a positive result? That's the thing, right? Again, it's a case by case basis. Would I recommend that if you want to take a max loan? Again, it really is going to depend on what your situation is and what you use that capital flow for. Is it to build cash flow? Is it to be a private lender? Is it to invest? What is this? It has to be able to net you a positive result, right? And then with responsibility, making those monthly payments or making those extra loan payments, as you saw in the examples here, like over here, if you see, like with this individual, this individual continued to make their payments, right? He made a maximum loan request, but he also made his payments, right? Loan payment, 1,700 here. Then you can see here, he took another loan, but he also has been making his loan payments and also still contributing to his policy, right? Being an honest banker. So kind of going back to what you said, you can take a 80 to 90% because look, he did the maximum loan request. So that's really going to be up to, that's slightly more than 90% of the value. But again, it comes with caution and it comes with as long as you're continuing to deposit more, as long as you're making the monthly, or excuse me, the loan repayments, right? Being an honest banker and making sure you're responsible with that money. Just like, I mean, these are prime examples of people who are implementing this, whether if it's self-financing for someone's nursing. I mean, look at this, right? The loan was taken out, but they're also making their loan payments and they're also making their regular premium payments too. So again, that's all with the level of growth. And then on top of that, they're still growing the 8%, 8.8%. So 3,000 grew by 3,000 that year on top of that.
Yeah.
So again, like I said, it's another one of those it depends type of thing. But yeah, and with an IUL, like I said, it's going to be 6 to 8. But I mean, you see here much more.
Yeah. We got one more question. So, what do you mean by flexible payments on the loan? So basically, you don't have a payment schedule. Kind of like if you take out a car loan, right? If you have a car loan, you have agreed that in 60 months, you're going to pay off the loan by paying X amount per month. When you take out a loan against your policy, well, against your cash value, there is no set repayment schedule. You have the flexibility to pay that at your own discretion. And in the event that you don't pay it and you have an outstanding loan, what's going to happen is at the end of the policy, once you pass, the death benefit is going to basically cover that outstanding loan plus any interest that it's accrued while it was outstanding. Does that make sense?
Yeah, and I'll add to that. So what do you mean by flexible payments on the loan? So say for example, and I'll compare it. So when we go to a bank, right? We go to a bank and we get a loan and we have a fixed repayment schedule, right? Where it's like, let's say $527 per month and you have to make that payment. Or let's say it's a car payment, you have to make that payment, right? Um, So the flexible payments allows you to put in some payments, right? You don't have to pay it off right away, right? You're not forced to repay every single month. maybe on a quarterly basis, you can chunk it down, right? Or let's say on a semi-annual basis, you can chunk it down, maybe even saving up inside of a high yield savings account so that way you grow that money and then you chunk down that policy loan. So there's flexibility here. Usually when you go to a bank and you get some loan, you're fixed on a repayment schedule. And if you miss, what does that do to your credit? Missed payments really hit your credit score, right? You guys know that. So this provides flexibility. Let's say 1 month you're a little bit lower on cash flow. Okay, you know what? Let me just make another deposit for the next month and save up a little bit more. So there's flexibility because this is your cash and this is your money here. So I may have missed it. Let me see. I may have missed it based on the question from iPhone 3. When you pay back the loan, does it go back to the cash value?
Sorry, I went
Yes.
ahead and answered in the chat.
Yeah, no problem. Yes, the cash value gets finished as you make the loan payments to the outstanding loan. Yes. Yes, you do. So, and again, remember, it's on a simple interest, not amortized. So
Yeah,
if you pay it off within 3 months, paid off within 6 months, depending on the size of the loan, I mean, the interest is slim to none. And then IULs
yeah,
also
that's
have
cool for a
different.
quick turnaround.
Yeah. So, um, and again, I wanted to reiterate that, like I said, these are the type of interest rates, index interest rates that we're getting. And you got 16, 15.29, 15.42. These are some pretty solid gains. I mean, I think you guys would agree, right? Um,
Oh, yeah.
yeah, so I mean, these are great questions, and I just wanted to share just the actual implementation. As you guys been coming to these weekly webinars, you guys are learning the different mechanics behind whole life, behind IUL, behind annuities. And then now what I wanted to do is show actual case studies and actual implementation on what some of our clients are doing in order to generate more cash flow and maximize their dollar. So thank you again, guys, for coming. Is there any other questions before we go? Um, let me see here. One more thing. Um, Saul, could you put our website link, our booking link inside of the chat? So if you guys want to book something, if you guys want to know a little bit more, maybe collect a little bit more information, um, feel free to talk to any of the team. Maybe I've talked with some of you before, but maybe a conversation could be had, you know? So I think the thing is making sure that it makes sense. And if it doesn't make sense, great. You know what? Like I think either way, it's a win-win. Right. So I'm glad you guys came to this. I want to take the time to thank all of you for hopping on. Let me see.
Yeah, there'll be a recording going out, so we will definitely send that out to you. We also have the in-person Salon of Wealth and Builders event. I believe, was it the 15th? The Thursday. Um, Sorry, 1 second, guys.
So real quick, so the vet on here is also Tita the vet. So that's my auntie. So thank you for coming on, Tita. But real quick, she's also a real estate investor. So I wanted to really briefly cover this note that we have a client that leveraged 50K from their policy, is earning 18% on this promissory note. So with the private real estate deal, 212. Yep. So what I got so far is that if you start a policy with 300 to 400 monthly payment, it could take a year before being able to take a loan. Um, okay, I'm gonna say this. You can take a loan, right? But are you gonna take a loan off of loan of $100 or a loan of $200, $300? So you can take it out, but does it make sense to, right? So maybe it would be good to capitalize the policy first, to deposit as much as you can into it first before looking at the loan. Unless you have a large lump sum up front, then that's going to supercharge the liquidity, which is 90% of what you put in, 90 to 95%. So, so yes and no. To your question, what is that? iPhone 3? Yeah, iPhone 3. So yes and no. 300 to 400, yeah, you can take a loan and we can make it very liquid and you can do it within the first month, but is it going to make sense for you to take a loan off of $300? Or would you rather like build that up and have maybe chunk in some money and have like 9 to 10 to 15 to 20,000 that you can leverage and deploy? That's the main thing. Yep, and we have another Solana Wealth Builders 212 in person. Yeah, it will be here at the
Yeah.
office.
And then True Beer is putting on our Wealth and Waves that Saturday. So the 15th. So if you guys want to learn more about this stuff, just come on by. That's going to be, I'll put it in the chat actually.
Wealth and Waves, is that what this is?
Oh no, this is just the weekly webinar series that we
Oh,
have.
got it. Okay.
Yeah.
But we cover a lot of this stuff in Wealth and Waves. So definitely the space to come learn more and ask more questions about that stuff or this kind of stuff.
Well, we got more questions. So a lot of questions came up as we had the actual implementation. So what is the approximate split from the monthly contributions to go to cash value and to policy? And then the second question is, so the loan is based on cash value, but would come out of the policy if not paid back. I assume the loan is off of the, okay. So let's go with the first question first. So what is the approximate split for monthly contributions to go to cash value to policy? So my next question to follow up that is, what do you want this to be used for? That's my thing. There's a way to structure it to where it's better for cash accumulation, or it's better to leverage and deploy into other deals. Like let's say with this one here, getting an 18% deal or 18% return on a real estate deal here. So that would be my next question to follow up with that. So it's not really, I can't say it's one way is the only way. It depends on what you want to use the policy for, right? Um, and then, so the loan is based on cash value, but would come out of the policy if not paid back. I assume the loan is off of the policy. Okay, so I think I understand what you're saying. So based off what you put in, right? So just like in when you buy a home, the more mortgage payments you make, the more equity you build, right? As you continue to build, like in the beginning years of your mortgage, it's obviously front loaded, right? So as you continue to build the cash value, and let's say you took a loan and you never paid it back, let's say, for example, you're putting $500 a month, your death benefit is 200,000 just for easy numbers. If you took a loan of 1,000 and never paid it back, that death benefit now turns down to 199, maybe even 198 plus interest. Right? So is going to be pulled from the death benefit if you never pay it back, though being a good steward of your money and being an honest banker. Yeah. Let me just move this chat box so everyone can see. This recording will be sent out. I know some people came in a little bit later, but we just went over a whole bunch of case studies from debt consolidation to investing into private real estate deals to private lending to lending to businesses, financing different things. And this is very unique to our company. 2:15 at the
Yeah, and
daily
we'll
desk.
we'll send the recording out as well.
Thank you for all the useful information. Much appreciated. TrueViewer Client Education Series, Whole Life Tim on, yep. So that's going to be 2-4. So we have these weekly. weekly webinar.
Yes. Oh, and Justin, Wealth and Waves, is it Saturday or Sunday? The 15th.
Let me
I
double
see Sunday,
check.
but because Saturday's Valentine's Day.
Yeah,
Don't want to get anyone in trouble.
February
yeah,
21st.
yeah, we're doing 221.
21st.
Yeah, 221.
Okay.
So, because yeah, like I said, no one, we don't want anyone getting in trouble, including myself. All right.
All right, everyone. We will see you next week. And thank you for
Yeah,
joining
and
us.
always be yeah, always feel free to reach out to any of the team members. We have these actual case studies. This recording will go out, but it's very unique the different ways you can leverage it and to capitalize and to develop cash flow, all of the above, and really just creating your own ecosystem, your own banking system. So that's the main thing, right? It's always this and another asset. So again, always feel free to reach out to any of the team members. We have our website. We also have our Instagram. You guys follow our Instagram as well. And we'll be happy to talk to you guys. Thank you. Thank you. Great questions. Thank you all. Awesome. All right, you guys take care and have a great evening.
Thank you. Good night.